you in a recap. Today's session will be recorded and the slides will be shared with you in a recap email that's sent after the event. It's my pleasure to introduce Tricia Haver, Chief Commercial Officer at the North Carolina Railroad Company. We're honored to have them as the presenting sponsor of the Manufacturing Council this year. Trish, the mic is yours, and thank you for being here today.
Thank you for having me, Gary. Good morning, everyone. I'm Trish Haver, Chief Commercial Officer for North Carolina Railroad Company. North Carolina's economic outlook is certainly a topic near and dear to our hearts, and we are really pleased and excited to be the presenting sponsor for today's events. As some of you may know, NCRR is celebrating its 175th anniversary this year. We were chartered on January 27th, 1849. But as excited as we are to celebrate our history, we're even more excited about our future. Over our 175 years of maintaining the rail corridor, NCRR has witnessed firsthand the power of the railroad to advance the economy. Like the industries and manufacturers that surge through our corridor, we too are forging ahead. Leveraging our flexibility as a private company, NCRR is ushering in a new era of progress, which is defined by world-class expertise with rail, strategic connections, and creative business solutions, all to feed the momentum of our rail system. As we look to the next 175 years, we are committed to being a rail partner that's forever in motion. You'll be seeing exciting new things from NCRR over the course of this year. And if you haven't already, please, we invite you to follow us on X and LinkedIn for updates. And of course, reach out to us directly if we can be of assistance to you. We love to find ways to innovate and collaborate with each of you on finding rail solutions. It is now my pleasure to introduce today's speaker, Chad Moutray. Chad is the Chief Economist for the National Association of Manufacturers, where he serves as the NAM's economic forecaster and spokesperson on economic issues. In addition, he is the director of the Center for Manufacturing Research at the Manufacturing Institute, which is the workforce development and education partner of NAM. Chad leads the efforts to produce thought leadership, data, and analysis of relevance to business leaders in the sector. Prior to joining the NAM, Chad was the chief economist and the director of economic research for the Office of Advocacy at the U.S. Small Business Administration from 2002 to 2010. He is also the vice chair of the Conference of Business Economists and is a former board member of the National Association for Business Economics, where he is the co-chair of the Manufacturing Roundtable. Chad is also the former president and chairman of the National Economists Club, the local NABE chapter for Washington, D.C. Please join me in welcoming Chad to the meeting.
Thanks, Trish, and thanks, Gary. It's always great to connect with folks in North Carolina, and you guys are doing a great work. So I'm gonna go to the next slide here, and I know that just is my contact information, but I'm going to use that in just a second, just to kind of give an overview of where we're gonna go with this conversation. So as Trish said, I'm chief economist at the NAM, also work for the Manufacturing Institute. So we can talk quite a bit about workforce. And when you think about the manufacturing economy, I know many of you continue to hear about how manufacturing continues to be challenged, and we'll talk quite a bit about that. But there's also a lot of mixed messages out there for manufacturers. There's a lot of optimism about a lot of investment that's taking place in the U.S., as well as this notion that overall we continue to see these kind of surprising signs of resilience, not just in the U.S. economy, but I think for manufacturers. And so hopefully I will leave you with a glass half full view of where manufacturing is headed. So now we'll go to the next slide here and start off with the NAM Manufacturers Outlook Survey. If you are a member of the NAM, the National Association of Manufacturers, you have another week here this week to fill out the Outlook survey. So this is showing you where we were in December, but we'll be releasing in March the first quarter data. And you can see that in December, we ended last year down below the historic average. Roughly 3/4 of our members are positive at any given time, looking at the historic average, and we've been below that average for a while. The next chart will show you a little bit more of that detail with 66% of our members. Next chart. Yeah, there we are. 66% of our members positive about their company's outlook in December. You can see that really over the last 3 quarters, that number really hasn't budged all that much. And we are still below that historic average. The next slide. I think one interesting thing here, number one, I guess 2 comments to make about overall expected growth rates. Number one, the one that is the most obvious, is that overall there's been quite a bit of slowing of expected growth rates really over the last couple of years. But basically 1.5% growth for sales was the expectation for manufacturers filling out the survey in December, production of about 1.7. And you can see quite a bit of deceleration there in general in many of these indicators. But I think the other comment to make about them, and this is not unlike what you see in a lot of other sentiment surveys as well, even in a very challenging environment right now, when you ask about the next 6 months or the next 12 months, there is this cautious optimism out there. And I think it's important to note that these numbers have not turned negative, right? So for all of the talk about manufacturing being in a recession, you are not seeing negative expected growth rates in any of these measures. And I think that's certainly something to at least hang a little bit of a hat on. Next chart. So one thing to comment on the 4th quarter data is that I think a lot of the people who are filling it out were a little bit more negative about their situation than I was. Spoiler alert, I've been in the soft landing camp for quite some time, and you'll see that a little bit later on in the conversation. But when people were filling out the survey in that late November time period, there was a bit of negativeness there, and you can see that here. So this is not a PMI, the Outlook survey. So, but I have tried to approximate one over the last 2 or 3 years, and you can see here that more folks were more negative in terms of what they were seeing in terms of activity in the 4th quarter relative to the 3rd quarter than they were positive, right? So that's partly what gives you, I guess, that negative PMI number if you were to do one. But I think the other comment to make here is that a lot of folks were just simply standing pat, right? So the largest numbers in each of these cases was people who said that there was no change between the 3rd and 4th quarter, and that was especially true for both hiring and capital spending. The next chart, we'll dig a little bit deeper into the top challenges that we are seeing right now. The number one issue, next chart, and the number one issue continues to be attracting and retaining a quality workforce. That has been the number one issue for 5 straight quarters. I've seen some of the preliminary data, and so don't be shocked if it's 6 straight quarters when we get the 1st quarter data. The reality is it is easier today to hire than it was 6 months ago or a year ago. We have certainly seen some cooling in the labor market, yet the labor market remains tight. The unemployment rate is still at full employment, and everywhere I go, every state, every region I go and talk to, everyone continues to struggle with where are they going to find workers. And I suspect in having conversations with folks from North Carolina, that's not any different. A couple other comments to make here. One issue that has been rising up the charts here, and that is the unfavorable business climate. We certainly are seeing a lot of regulations coming out of Washington right now. I happen to sit in the policy office at the NAM, and I know that we're commenting and looking at well over 100 regulations that are being promulgated right now. And so that onslaught of regulations is something that I suspect a lot of manufacturers are focused on. The other aspect of that is obviously taxes, with the tax trifecta hopefully working its way through Congress here in the next few weeks, but also just this recognition that whoever wins the next election will shape tax policy for the next decade, given that those tax cuts that we all enjoy from 2017 are going to expire next year. And so I think the combination of those two things have really continued to rise that up the list a little bit in terms of priorities. Next chart. So the headline here is that fewer members in December felt we were going into a recession this year. So if you look at this question relative to where it had been in some of the prior quarters, you know, we had well over a half, almost 60% of our members in the second quarter of last year who thought we were going to fall into a recession at some point in the next 12 months. That's fallen to roughly a third. You can see quite a bit of a mixed bag here. 41% of our members were uncertain, with a quarter saying we weren't. So, you know, I think since then, obviously, there's been a larger recognition that a recession is looking a little less likely, or although still possible. And so you know, we did not ask this question in the first quarter, but I suspect if we had, that number would fall even further from where it is there. Next chart. So we're going to move away from the NAM survey to the ISM, the Institute for Supply Management's Purchasing Managers Index. We'll get a new reading for this at the end of next week, because we always get a new number on the first day of the month, and March 1st is a week from Friday. And so, I mean, if you think we're in a recession, you probably are looking at the ISM chart, right? The reality is that the headline number here, which is blue, has been below 50, which would be kind of the cutoff for expansion, below 50 for all of the last year, for a little bit more than all of the last 12 months. But the good news here is that I actually continue to see some stabilization here. I think that the rate of decline continues to slow. And when you look at this chart, you actually see some progress really over the last 6 months in terms of moving in the right direction, even if that overall headline number still is just shy of 50. We did see new orders grow above 50 in the January timeframe, and so that gives you at least a little bit of a green shoot that hopefully we'll continue to see some additional progress and hopefully expansion in the coming months. Now, this is the ISM for the US. I'll tell you a very similar story when we get to the global picture a little bit later on with the S&P global figures. Next chart. So obviously, I started off this conversation talking about how manufacturing continues to be challenged, despite what I just showed you a second ago about some stabilization. And so certainly the January data were challenged kind of across the board, right? We had a number, to the extent we've had bad weather in January this year so far, this winter, January was the month where we saw the bulk of that, right? And so when you look at a lot of the data points for January, whether that's manufacturing production or housing or retail sales, many of them were weaker, largely, at least in my view, on some of the poor weather that we had in the month of January. So you did have a disappointing figure for manufacturing production for January. I wouldn't be shocked if that flips around and you see a little bit better data once we get to the February figures. Again, as you look at these data, you see quite a bit of a mixed picture overall. But the next chart will show you kind of stepping back a little bit and looking kind of at that larger kind of time frame. Next chart. You know, we've seen some declines in manufacturing, but I think it's important to see that the bottom has not fallen out here, right? We peaked off at manufacturing production in April of 2022. You can see that capacity utilization in that particular month was 80%. You know, the last time we had hit 80% was in the year 2000, so it's in 22 years. Capacity manufacturing production itself really had kind of continued to grow coming out of the pandemic and kind of peaked off in that time period. When you're looking at overall manufacturing production, though, since then, it is down 2.1%. So definitely it's down. And you hear that when you talk to a lot of manufacturers, that things are pulling back. But I also hear from many of them that if you're going to pull back, at least you're pulling back from a relatively strong base, right? And so, again, the bottom has not fallen out. There's been a little bit more resilience there than I think, are giving it credit for. Notice that this is all manufacturing. The next chart will show you that there's a lot of variation in that sense, right? When you're looking at the overall January figures, which just remember, go back a couple charts and you'll remember that the January data were pretty disappointing, right? We were expecting a slight increase. Instead, they were down 0.5%. And so you have a lot more negatives in January than you would like to see. When you look at the next chart, though, you see on the year-over-year basis, sorry, I guess I didn't give you year-over-year. I gave you since the pandemic, but very similar storyline in terms of what sectors are towards the top of the list here. You can see a little bit more of a mixed picture here in terms of what sectors continue to fare well. There certainly are a lot of positive stories to tell about some of those sectors at the top of the list. Aerospace, miscellaneous durable goods. You can insert medical equipment in that conversation. Computers, when you say chemicals, you probably are also adding pharmaceuticals to that conversation and continuing to move down the list. There are sectors at the bottom of this list which probably are in a recession, while some of those at the top are not. And so, again, lots of variation here in terms of where manufacturers lie, despite my comment about only being down 2.1% over the last really couple years. Next chart. So moving into factory orders, you can see that when you look at some of the factory orders data, a lot more positive here than I suspect you kind of see in some of the mainstream press. You can see that we've had really over the last 6 months, only two quarters really where 2 months really where you had some declines. You do need to strip out transportation equipment because we do tend to bunch those plane orders in particular up around auto shows. And so when you strip out transportation equipment, you can see that 5 of the last 6 months, we actually had increases. That October reading was largely influenced by the UAW strike and what we were seeing with the big 3 automakers at that time. Although, as you can see, we bounced back after that. The next chart will show you, again, I tend to be a glass half full guy. When you look at overall factory orders and factory shipments, they actually were slightly positive for the year, right? They were up, nothing to write home about as far as being really gangbusters growth, but at least you were having like 1.5% or so growth in new orders and shipments for all of last year, especially when you're stripping out transportation equipment. So while these lines look relatively straight, they are slightly positive, moving in the right direction. Again, to me, a sign that the sector, while it's been challenged, is seeing some signs of stabilization. Now, one little asterisk I should put after this particular chart, as well as the next one, is that these are nominal numbers, right? So if you were to adjust these for prices, they would be probably slightly negative. But again, that larger nominal story continues to be one of resilience, which is good. The next chart, which I like to show you, is that I started off this conversation by talking about a lot of mixed messages, right? The fact that the bottom has not fallen out, and this next couple charts probably will show you a little bit more about why that's the case. So this is core capital goods spending, right? You can see how that's defined. This is part of the factory orders data that we get, and it's a proxy for capital spending in the U.S. It's not unheard of for me to talk to anyone in that core capital goods space, right? Who says to me, "What recession? I don't see a recession. I can't keep up with all of the demand that's out there." And this chart really kind of helps explain a little bit of that, right? Manufacturers and businesses overall are continuing to invest in new technologies. They're investing in new equipment. You'll see in the next chart, lots of investments in structures. And so in my view, that all kind of really lends itself towards hopefully something that's going to continue to grow productivity moving forward, but a sign of health in the economy. As you can see on this chart, this gets a lot of attention in Washington, and this is private manufacturing construction spending. We'll get a new reading of this one also at the end of next week. But you can see that we are very close to an all-time high for private manufacturing construction, up a whopping more than 60% over the last year, up more than double that over the last couple of years. And a large part of what's happening here is quite frankly industrial policy, right? The bulk of this increase is coming from the CHIPS and Science Act and all of the semiconductor investments that are taking place around the country. You also have a lot of investments coming from the Inflation Reduction Act, which is largely around the energy space and new EVs and batteries and other kind of investments. A little bit of this is maybe coming from the bipartisan infrastructure bill. To me, though, largely, despite it's two things. Number one, it's industrial policy, but the other big part of it to me is reshoring. We continue to see a lot of reshoring and nearshoring happening in this sector. A lot of manufacturers have a China Plus One strategy, for instance, and so the U.S. is faring fairly well there. We're not the only ones benefiting from that phenomenon, but you're seeing quite a bit of investment taking place here, and this chart kind of helps to show that. When you look at this chart, though, yes, should give you optimism about the future, But it's also important to note that this is just shovels in the ground. None of this construction is up and running yet. None of these facilities are operational. Look for them to be operational as you move towards the end of this year, 2025, and into 2026. And so these are just shovels in the ground. Every one of them will have a help wanted sign attached to it at some point. And you're already starting to see storylines out there about some of these investments and how difficult it is to find workers. Goldman Sachs estimates that we're going to need another 250,000 manufacturing workers to fill all of the jobs associated with this chart. And so it shows you that in a very tight labor market, things could get very tight, even tighter over the next couple of years. So next chart. I'm going to change gears a little bit and talk about the global economy. And much like the ISM chart, you do see a global economy that has been really challenged over the last couple of years. And there's still a lot of challenges out there, especially in Asia and in Europe. But we're seeing a lot less red on this chart than you would see if I were to do this presentation 2 or 3 months ago, right? You're seeing trend lines in the right direction. You have 4 economies of the top 10 markets that saw expanding manufacturing growth in the month of January. That's up from just 2 in December. And the reality here is that of these top 10 markets, 8 of them had higher PMI values in January than they had in December, right? Does not take away from the notion that we're still challenged as a sector globally, but you're starting to see some stabilization in the right direction, and that to me is an encouraging sign. Many of you might be shocked to see China blue here, given all the storylines there with certainly coming out of zero COVID and all the problems that they're having. But those figures, while they are still challenged, are again moving in the right direction, and that's why that figure is blue in this chart. The next chart kind of takes that a step further. I'm probably the only economist that uses candlesticks charts, but I like to look at it just to show you kind of that dynamism that we've seen over the last 6 months. And again, there's a lot more green on this chart than you would have had a few months ago. If it's green, it means that the PMI figure in January is higher than it was in July. And if it's red, it's the opposite, right? And so a lot more green on this chart. So that's obviously a positive story. The next chart will show you what's happening with the dollar. We'll get a new reading from the Fed later today on what the dollar did last week. But you can see here that the dollar's been quite volatile over the last year or so. It rose pretty steadily, kind of peaking off in that early October timeframe. If you go back to that, you go back in your time machine back to early October. Remember that 10-year treasuries were close to 5. They actually were over 5%. You had mortgage rates approaching 8% for a 30-year fixed rate mortgage. The dollar was soaring. The stock market was falling. And there was a lot of worry about the fiscal situation, right? Since then, the Fed has become a little bit more dovish, right? And you've seen rates fall pretty dramatically in terms of interest rates, coming down to around 4% for a 10-year treasury, roughly 6.5% for mortgages, and that's brought the dollar down, right? We've seen the dollar rise though year to date about 2% or so. That's largely, at least in my view, on the fact that the Fed is going to cut rates this year, it's probably going to cut rates a little slower than some market folks kind of originally estimated, and so that's pushing the dollar up a little bit. So quite a bit of volatility here. Why did I go through that chart? Obviously, the dollar matters when you're trying to grow exports. The dollar has a bit of a nuanced effect for manufacturers because a strong dollar obviously makes your imports cheaper. But it does challenge export growth if the dollar rises too much. Okay, next chart. So let's do a number of charts here on the employment rate. Again, this was the #1 issue for manufacturers. And you can see that we had 2 months of really strong non-farm payroll growth, both in December and January. That January figure, 353,000, was almost double, actually, what a lot of economists were expecting, including myself. So a lot stronger end of last year and beginning of this year. And the next chart will show you that overall, the unemployment rate continues to be 3.7%. So we're still at what we economists call full employment. That is up from 3.4%, this time last year. 3.4% was the lowest since 1969. So we're up a little bit from there, but still in a full employment range. We've never had a recession and full employment at the same time. And so to the extent you're looking for how this time might be different than past kind of challenging moments, that's certainly part of it. I do expect this number to rise over the coming months, perhaps getting closer to 4, maybe a little over 4. But that's still a great number, right? And so it's a sign that really the labor market continues to be solid. The next chart will show you the labor force participation rate. We have seen some declining participation in the last couple months. I do expect that to turn around. And in general, we've seen a lot of folks moving off the sidelines in the last year, which has been encouraging. This number is going to continue to fall in general because of demographics as more baby boomers retire. But hopefully we can continue to at least get young men with less education to continue to come off the sidelines. That has been one of the more challenging aspects of the labor force in the last few years. The next chart will show you manufacturing. And we've actually had some decent growth in manufacturing production at the end of last year. But in general, 2023 was a relatively lackluster year for job growth. We only added 22,000 workers overall. Again, you're seeing a little bit of volatility there because of the UAW strike in that October and November time period. But I think the key thing, we'll go to the next chart when I show you this. The key thing here is that, go back to that resilience word that I've used several times here. We have largely sustained the job growth that we saw in 2021 and 2022. So you can see the numbers on this chart. We added more workers in those 2 years for manufacturing than we have in any 2-year period since 1983 and 1984. And largely we sustained that with a 22,000 workers added last year. To the next chart, we'll show you kind of what that looks like graphically. So that, again, the resilience in the overall hiring figures, we're just shy of 13 million workers in the economy. And that January figure was the highest we've seen since November 2008, right? So you're still seeing overall employment in the manufacturing economy really hold its own for all of last year. And I would expect that we'll see about 100,000 or so new workers added in 2024. Go back to my earlier comment about that hockey stick of construction, and you're going to start seeing some of the effects of that as we move through the course of this year. The next chart will start digging into what the JOLTS data, the job openings and labor turnover survey data. I have a bit of a month lag here with these data relative to the overall job numbers. We'll get a new update for January at the beginning of next week. And when you look at this chart, you can see two things. Number one, if you look at the bottom here with the green and blue lines, you can see that overall activity for hires and separations continues to move down, right? So each of those numbers is at a post-pandemic low. And so you are seeing signs that the labor market is cooling off a bit. But overall job openings, the red line here, we still have more than 600,000 job openings in manufacturing. So we're still seeing very solid job postings. I've been in this role long enough to remember when 450 was a great number, and we've been pretty solidly above pre-pandemic levels for all of the last couple of years, even if that number has pulled back from 1 million job openings in April of 2022. Again, a peak period that we mentioned earlier. The next chart will show you quits. If you're looking for a place where I think if you're in HR, you're really happy to see this chart. Churn is certainly slowing down pretty significantly. Go back 2 years, kind of that beginning of 2022 period, we were seeing record levels of quitting, right? People were leaving you to go across the street and get, more money, or you're certainly seeing lots of activity happening in terms of overall quits. Those have pulled back, and you are starting to see quits approaching pre-pandemic levels. And so again, it's welcome news overall. If you're trying to look for workers, it certainly has become easier today than it was a couple of years ago, certainly a year ago, or certainly 6 months ago. And this chart helps to show a little bit of why that's the case. But the next chart will show you why workforce is still the #1 problem. And that is that we still are upside down in terms of the number of job openings to the total number of unemployed. So roughly, I'm rounding off here, you roughly have 9 million job openings in the US and 6 million, again, rounding off there, unemployed Americans. And so for every 100 job openings in the U.S. economy, there are only 60-ish people who are actively looking for work. And so this is why everyone really is scrambling, chasing after the same workers for talent. And in my view, this is a demographic problem. This is a structural problem that isn't going to go away. We're going to be talking about workforce issues for all of the next decade, in my view. This number has narrowed, right? So if you go back a year, it was a 2-to-1 ratio. It's certainly eased off a bit since then, but it's still a problem. And again, a problem, at least in my view, that's not going away. The next chart will show you the effect of that for manufacturers, and that is that wage growth continues to be really solid, right? You had I'm going to give you monthly numbers here, 0.9% growth in manufacturing wages for production workers in the month of November. That was followed by another 0.9% growth figure for the month of December and 0.3% growth in January. Overall, average hourly earnings for production workers is up 5.3% year over year, so really solid numbers. The average wage, this number is $27.15 an hour. I do expect that to cool off again a bit, maybe moving down into the 4s at some point over the coming months. But I've been expecting that for a while, and it hasn't happened right away. And so this is a sign, again, of just how challenging of a labor market we have right now. And just to kind of aside to that, you're seeing even faster growth in some other sectors. And so while manufacturers tend to pay more than other sectors, you've seen that gap narrow a bit. Next chart, we'll dig a little bit into inflation. So I'm going to go through 3 charts here on inflation. They each tell a very similar story. And so I always start off with this chart. This is the PCE deflator, the personal consumption expenditures deflator. It's a fancy word for the price index for personal spending. This is the price index that is preferred when you're measuring inflation for the Fed, right? So this is when Jay Powell comes out and says he would like to see core inflation at 2% over the long term. He's referring to the red line here, and you can see that we've made a lot of progress there, but it's still above that 3% threshold, above that 2% threshold. I'll do the next 2 charts quickly, and then I'll give a kind of quick summary. So we'll do quickly the producer price index. This was a chart that came out last week. This is wholesale prices, and you can see that there's been a lot more moderation there for some of these raw material costs than you're seeing on the consumer side. Nonetheless, a very similar storyline. And then the last chart I'll show you here on inflation is the consumer price index, also a number that was released last week. And so the storylines here are twofold. Number one, you're going to continue to see moderation in these figures. The year-over-year numbers continue to move in the right direction, albeit very, very slowly, right? I do think it's possible for the Fed to meet its target of 2% by the end of the year or the beginning of next year. But again, a much more sluggish deceleration than we would like, but it is moving in the right direction. And so that is certainly a positive storyline to tell. But the challenge for the Fed is that prices continue to be sticky, right? And so if you look here at the overall headline number, you can see it's really kind of just bobbed along kind of relatively flatly in the last few months. You're still seeing quite a bit of inflation, particularly for services, with transportation equipment, transportation services. If you've flown anywhere or stayed in a hotel, you've seen how expensive those numbers have continued to kind of hang in there. Medical equipment, housing, all of those things are continuing to provide quite a bit of inflation kind of stickiness there. As a result of that, the Fed is likely to cut rates starting as soon as the May meeting or maybe the June meeting. We'll see where they end up landing there. But that's kind of a bit of a shift from a lot of expectations that they would start cutting rates as soon as their March meeting. In my view, the March meeting, and of course, Jay Powell has more or less said this explicitly, the March meeting is now off the table. And so the soonest that they would cut rates by 25 basis points would be the May meeting. I still see them cutting rates 3 times this year, likely in the middle of this year. I don't see them wanting to cut rates as you get closer to the election. And so probably the May, the June and July, maybe September meetings would be kind of the meetings that would be active for this year. I will make one comment here about inflation, and that is that when we economists talk about moderating inflation, there's still a recognition out there. Inflation is still a big concern on the consumer side. We had consumer sentiment survey numbers that came out last week where inflation is still a top problem. While we're seeing moderation of inflation, that does not mean that prices are falling, right? And so when you ask the average everyday American about inflation, they're going to be referring to the fact that prices when they go to the grocery store, et cetera, are still much higher today than they were 2 years ago. And I think there's still a recognition that that is still a problem, and certainly a political problem as we move into this election this year. So then we'll do the outlook, and then we'll have time for Q&A. So next, we'll go 2 charts forward. And you can see that we grew 3.3% in the fourth quarter. That was stronger than we were expecting. I was expecting a number around 2.4% growth for the fourth quarter, so that was a bit stronger than we thought. I see the current quarter that we're in growing around 2%. I know that there are other forecasts that have it slightly higher than that, but you are seeing a little bit of a slowing off in some of these cooling patterns. I'd like to see a number closer to 3. I think we've seen some nowcasts that are around 2.9 right now, but I think it'll probably settle off around 2. In general, though, I see this is the soft landing scenario. I think we're going to continue to slow over the course of this year, and then by the time we get to the fourth quarter, start to come out of it a bit as you're moving into 2025. I actually see us growing around 2% or so this year. I'm going to go forward 2 slides. Okay, so even though I've presented to you and I've said that I'm in the soft landing camp, I think it's important to note that there are still a lot of downside risks, right? A recession is still possible, right? The number one risk in my view is geopolitical risk, right? When you ask economists right now about some of the biggest risks that are out there in terms of the overall forecast that we have, you got to look at what's happening in the Middle East, right? You got to look at what's happening with the Houthis in the Red Sea, and the fact that freight is now having to move around the Cape of Good Hope. The Panama Canal is having issues, obviously, with being the water levels being pretty low, and so all of those things are certainly things to look at in terms of rising costs for freight, but also in terms of just that larger geopolitical risk. We obviously still have issues in the Ukraine as well as Taiwan that are kind of lurking behind the scenes as well. I have slowing global growth here as a downside risk. I could put it actually in either camp because I do think we're starting to see some signs of stabilization there, but it's still weaker than we would like, and so that's why I've kept it in the downside risk category. The reality is we've been trying to talk ourselves into a recession for the last couple of years, and so that is going to continue to be a downside risk as long as that continues to happen. While I had a third of our members in December feeling that we were going to have a recession this year, you had in kind of a similar number in December for the consumer confidence figures. Roughly 3/4 of consumers felt we were going into a recession this year. That number has fallen to roughly 2/3, and hopefully will continue to move lower. But there is still this fear out there that a recession is possible, and we continue to try to talk ourselves into one. The other red flags to watch, we could have another possible government shutdown, right? We continue to kick the can down the road this year. I don't think that will happen, but that's certainly some fiscal spending uncertainty continues to linger out there. And I mentioned the UAW strike a few times. I do think we're going to continue to have labor issues moving forward, and so those are all things to watch. On the upside, the soft landing scenario, at least in my mind, continues to run through the labor market. The fact that we still have a solid labor market with solid wage growth is continuing to provide some resilience on the consumer spending side that has really kept the economy afloat for all of 2023 and will help us in 2024. I think even if we were to have a recession, it would be a much milder one because of the labor market and because of that continued resilience. I put the Fed, I moved it from the top to the bottom here because they are no longer going to be raising rates, and so they have shifted now towards the posture of cutting rates 3 times at least this year, and so that puts them in the upside risk category. And then you have to talk about all the investment that's happening in the U.S. in terms of that reshoring in industrial policy, and so those are all kind of going to provide some tailwinds to the economy as well. I'll end on this last chart here, which is manufacturing production. We had a pretty challenging, as you can see here, industrial production figures over the last year, but I see that starting to rebound a bit over 2024, growing Again, nothing phenomenal, but at least it's a positive number, roughly 1% this year. So the last chart there just shows you my contact information. You can put that up if you want to, but I'm ready for questions. And I think, Jake, you have them for me.
Yes, thank you, Chad and Trish and the North Carolina Railroad Company and all of our attendees for joining us today. We appreciate you being on and taking some time out of your day to do this. My name is Jake Cashin, and I am VP of Government Affairs for the North Carolina Chamber, and I'll be moderating the Q&A portion of this webinar. Chad, we've had a number of questions come up, and I've been tracking them. We've had some primarily around workforce, but here's one that came up around the private manufacturing construction, and I also had my own question related to that. So for the private manufacturing construction spend chart, do you have data split by sector? Can you clarify which sectors are driving the growth and which are lagging? And I'd also add, it looks like it was sort of near the peak in this chart. How do you feel about that construction spend longer term?
So the White House did a really great blog post about 4 or 5 months ago. Actually, the Treasury Department did. The bulk of that increase is coming from semiconductors, right? The bulk of it. The other elements of that are from EVs and batteries, and the announced ventures that are taking place there. I have not seen a breakdown of other sectors there. I think maybe the Treasury Departments did a little bit more, so I certainly couldn't speak to who's lagging behind. But those are the sectors that are faring the best.
Okay, thank you. How much of the difficulty in hiring is lack of candidates with proper skills?
That's a lot of it, quite frankly. You know, the reality is that there is quite a bit of a skills mismatch. If you go back a couple of years when the labor markets were really super tight, right? I think people just wanted people to come in the door, and so I think when you're looking at those skills challenges for the manufacturing sector, number one, we've got to change perceptions about what manufacturing is and what it isn't, right? And the Manufacturing Institute has done a great job with Manufacturing Day and a lot of other initiatives, Creators Wanted, to try to help change some of those perceptions, because you got to get people actually knocking on your door to apply for you, right? But outside of that, it is kind of this realization that everybody is chasing after some of the same workers. I mean, I know every manufacturer I talk to says that they're having trouble finding engineers, right? There's a lot of need for workers in the trades. On the trade side, you know, you don't even need to have a bachelor's degree or anything else, right? You just need to have some kind of a certification or maybe some limited college experience for some of those roles. The other challenge that is out there is, given how tight the labor market is, finding entry-level workers is a real challenge, right? We have a lot of what I'll call non-traditional players competing for talent, right? Everyone has an Amazon distribution center in their district or region, right? Retail and restaurants and other things are also posing a challenge. Again, as that gap has narrowed, you're seeing folks moving into some of those other pockets. In North Carolina, banking, right? I think the minimum wage for bank tellers is now over $20 an hour, right? And so you certainly you're seeing that entry level also being squeezed a little bit as the competition has really become a lot more fierce.
Yeah, it's amazing. We were at a manufacturing tour, a manufacturing facility yesterday on a tour, and the leadership asked them what their top issues were, and it was workforce. So it's everywhere. So here's one question for you, Chad. From what I hear from some who work in manufacturing, some of this is limited or decreased production. This may be due to increased red tape or overall scrutiny and regulations. Does this sound like a valid theory? What as the biggest factors for decreased production?
Yeah, I mean, I think certainly there is certainly a big focus on what's happening on the regulatory front. Like I mentioned this earlier, we're in kind of a period here on the federal side, given that it's the 4th year of a presidential term, where the administration is just cranking out regulations. To a certain extent, that happens in every term, Republican and Democrat, but you're seeing a huge influx here that's happening in the Biden administration along energy and SEC and labor laws, rules, et cetera. And the goal here for the administration is to get as many of these done by the summer as they can. Anything that's done after that point, if there's a turnover in power, it could be subject to the Congressional Review Act, right? And so there's a huge hurry to get these out the door. And if you're especially a small and medium-sized manufacturer trying to keep up with all the regulations that are coming at you, this can pose quite a bit of uncertainty, right? And so we've had surveys out there that show the impact that that can have. And we did a study on the cost of regulations that was up on our website that shows you just the disproportionate burden that manufacturers have for those compliance costs, but also for small and medium-sized manufacturers. And so I do think it matters. I think that's on the regulation side. And I think it has a bigger impact for the small and medium-sized firms.
Great, we appreciate that. We've got time for a few more, so I'm going to try to keep them diverse moving forward. Here's one. In light of consistent full employment and continuing need for workers, how is technology adoption like automation measured as an economic indicator? Or is that something you can pull out as a subset of capital investment?
I think a lot of that capital investment is new technologies. You're certainly seeing a lot of investment in R&D, right, as well as new equipment, right? And so that to me is a sign that manufacturers and businesses writ large are investing in each of those categories. The reality is we're in a tight labor market. And so you're seeing a lot of companies who are saying that they're going to be using more automation, more robots in terms of their production. Automation certainly is going to be looking much more attractive. Doesn't mean anyone's laying anyone off, right? It just means that it requires a different type of worker. Maybe a worker who was doing that job before is upskilled and moved elsewhere on the shop floor. But we know that there were more robots purchased in 2022 than any year in history. And I haven't seen a number for 2023 yet, but I'm sure it's even higher, right? So we do know that we are seeing a lot of investments in that space. Everyone is talking about AI, right? In fact, the NAM is going to be releasing a paper on how manufacturers are using AI in that kind of that March timeframe. And so all those I think are important. Manufacturing productivity has lagged over much of the last decade, but I'm pretty optimistic about productivity growth moving forward, given some of those investments that we're seeing taking place.
Right. Yeah. Yesterday's tour asked the question about AI, and they were just now kind of getting involved with it. This is a highly skilled manufacturing facility, which was that, while there's a lot of discussion out there about AI, manufacturers seem slow to incorporate it into their businesses.
Yeah.
North Carolina has seen a lot of growth in the auto, aerospace, battery sectors in the last few years, while simultaneously becoming a desirable place for immigration. How do you see these developments impacting manufacturing workforce?
So I didn't mention immigration earlier, so I'm glad it came up. I mean, the reality is we need immigration reform. I mean, a lot of the demographic challenges that I described to you earlier. We have reduced birth rates. We have a lot of retirees. The baby boomers are halfway through their retirements. Those of us in Gen X will be next, right? And so immigration can fill part of that gap. And so, we need to do something about comprehensive immigration reform to have, illegal. We need more visas. We need the backlogs for some of those visas to kind of clear up. And we need to obviously do something about the illegal immigration and borders. And so we've been pushing something at the NAM along these lines for quite some time. And so I think immigration certainly provides at least some solution there. What I like to point off on anytime I talk about immigration is Canada is seeing a population explosion right now, and largely because they've been taking a lot of those visas and high-skilled immigrants that can't get into the U.S. So they're benefiting at our expense at this particular point. In terms of the other things that you mentioned, yeah, you're going to continue. The whole Southeast area is continuing to really boom on autos and some of those other sectors, right? I think that North Carolina has been able to really benefit from being part of that overall larger ecosystem. Obviously, the auto sector is changing really dramatically, as you've seen, right? That move from ICE to EVs perhaps is a bit slower than demand might have suggested a year ago, but there's a lot of change happening in that space, and you're continuing to see a lot of investment there, as judged by those construction numbers that I showed earlier.
Yeah. Here's a really interesting question. I'm going to maybe put you on the spot, and I don't know, where it may be coming from, but I think the president's been talking about this here recently. But comment question about inflation and how much do corporate profits contribute to inflation? And my screen just changed it real quick. And well, yeah, people are upset with the government about inflation, but is the private sector driving inflation as well?
I mean, you hear that storyline a lot, that it's those greedy corporations and businesses that are passing on their costs, and that's what's causing inflation. I mean, the reality is prices are rising, right? And for much of, even though I showed you the PPI numbers earlier, you were seeing even faster growth in producer price indexes than you were seeing for consumer inflation, right? So, businesses largely were they weren't passing all of those costs on to consumers for much of the last couple of years, right? So they were absorbing at least some of those extra costs that was cutting into their overall profit margins, et cetera. And so I don't think it's as simple as to say that inflation is simply was the cause of greedy corporations or companies in any way. I know that there was the controversy about shrinkflation a week or so ago. I mean, the reality is businesses largely either absorb some of those costs, or they pass on some of it, but it's not the root cause is not coming from businesses themselves.
Chad, we have about 2 minutes, and I want to, maybe you can quickly summarize this or direct us to a location for this next question. But I want to get this one last question in before we leave. But where do you see the cost and impact of continued government regulation as a cost production versus input cost? Do you have any studies or research papers on that?
So if you go up to our website, I mentioned earlier, the NAM.org /regulation. I think it's regulation, not regulations, but one of those. You'll see a study on the cost of federal regulations, and so I think that's the first place I would point to. And look, we at the U.S. we have an ability really to benefit from all the reshoring and conversations about competitiveness that's happening in the U.S. right now, right? Given kind of the global dynamics that are out there. If we make ourselves less competitive, that's going to impact some of that, and we're going to see declining investment, declining new construction as a result of that. And so, what we've been urging the administration is to, yes, we hear your priorities, but we also need to make sure that the overall regulatory picture is smart, right, and doesn't really hamper the ability of companies to grow and stay competitive.
One final question, and this is very important to us here in North Carolina, but how do you see the NLRB's role going forward now that several companies are challenging its constitutional validity?
Well, that's not an area that I would say I'm an expert in. I do expect we're going to continue to see quite a bit of labor activity. You've already seen quite a bit of it in the last few months. And obviously the NLRB, the administration is going to continue to make it easier for labor organizing to take place. We're certainly following each of those issues as closely as we can and following what's happening with labor policy. But I'm not an expert there on NLRB by any stretch of the imagination.
Yeah, we carry with pride being ranked 50 in United States in the country, so that's something. Yeah. Hold dear. So, but we would like to thank you all for all that you do to keep North Carolina's economic engine running. As you know, the North Carolina Manufacturing Council is a group open to NC Chamber Cornerstone members, and those members are diverse in location, size, and products made. The council is best poised to solve the complex problems facing manufacturers when there are many voices in the room and at the table. We welcome your input and participation. We will provide a way for guests to inquire about membership via recap email, which will go out in the next day or two. The email is also included any resources that we have permission to share from today's event. Before you close out of today's meeting, you will be prompted to complete a survey about your experience. We appreciate you taking a few minutes to give us your feedback. We also have additional events coming up soon, which you can see on your screen. Visit our website for more information, ncchamber.com. Once again, thank you for joining us today. We look forward to continuing to work on your behalf this year, and we thank you for what you do to keep North Carolina moving forward. And remember, what's made in North Carolina makes North Carolina.